This is Macro Horizons, episode 348, Falling Back, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of November 3rd. And as Sunday marks the end of daylight savings time, we look forward to an extra hour of insomnia. Thanks, Powell. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the most interesting event came in the form of the FOMC decision. Yes, the Fed followed through on the widely anticipated 25 basis point rate cut, which brought policy rates arguably into the window of a version of neutral. Even Powell admitted in his press conference that most estimates of neutral are somewhere in between 3 and 4%. And as we move into that area for policy rates, it will be interesting to see whether or not the Fed ultimately delivers the 25 basis point rate cut that we've been anticipating for December. All else being equal, we continue to expect that a 25 basis point move at the final meeting for this year does in fact come to fruition. Now, we're certainly sympathetic to Powell's attempt to prevent the market from fully pricing in 25 or, frankly, even risking pricing in a 50 basis point rate cut in December. Clearly, the tone that Powell intended to set at the press conference was, at least in part, to discourage such aggressive pricing on the part of the market. Clearly, we'll have more information by the time the Fed makes its next decision on the 10th of December. We're still in a period of particularly high uncertainty given that the government remains shuttered for the time being. We are, as a market, beginning to look at more private data or non-traditional economic data releases, and the Fed has acknowledged that they are doing so as well. This will make the ADP numbers all that more interesting when they are released on the 5th of May. Let us not forget that the price action itself has been comparatively muted, all things considered. Yes, the front end of the curve did cheapen somewhat on Powell's comments, but by no means dramatically so. The FOMC also announced a few changes in terms of the balance sheet. The official end of QT has been scheduled for the 1st of December. Perhaps even more importantly, the Fed announced that it will allow maturing mortgages to be rolled over into the bills market. Not only will this provide a little liquidity because the operations will be in the secondary market, but it will also help alleviate some of the stress in the funding market that became evident in October. Now, with ample reserves currently at hand, the year-end turn and any funding stress associated with it will become all that more relevant. And while we're not expecting a particularly troubling period for funding, it is a factor that does need to be on the radar as we consider moving into the next phase of the cycle. The Fed is done shrinking its balance sheet, and for now, the objective appears to be keeping the balance sheet stable while allocating away from MBS in favor of bills.
Well, Ian, the government shutdown, it couldn't stop us this week because the Fed show went on. We got a 25 basis point rate cut. The committee announced that QT will be coming to a conclusion in December. However, we didn't see any tweaks to some of the Fed's administered rates, most notably IOR and the standing repo facility rate, nor did we see the announcement of any temporary open market operations. Instead, the Fed only went as far as to announce that their maturing mortgage bonds will be reinvested in the secondary bill market, although, to be honest, with that amount of liquidity summing to around $15 or $20 billion a month, it's not much more than a drop in the bill market bucket. Instead, from a broader macro point of view, the biggest takeaway is what we heard in the press conference and the fact that Powell said a cut in December is not a foregone conclusion. Rates moved higher and the curve bear flattened, although stabilized during Thursday's trading, and we saw December cut pricing move from nearly fully reflecting a 25 basis point cut to something closer to a 50-50 chance that the Fed goes again before the end of the year. Data dependent, of course, if we get any data.
Yes, depending on the data in this environment does strike us as being somewhat ill-advised, although the reality is that at the end of the day, Powell followed the September game plan. We got a dovish statement, a 25 basis point rate cut, and then at the press conference, he attempted to walk that sentiment back by sounding a little bit more hawkish or at least less dovish. December is not a foregone conclusion from the Fed's perspective, or they would have gone 50 at this meeting. But it is likely, and I'll argue more likely than the 50-50 odds that are currently being priced into the market. Instead, what I suspect that Powell was attempting to accomplish was to prevent the market from pricing in more than 25 basis points, because the worst case for the Fed would be an environment in which the economic data remains conspicuously absent, but the market prices in, let's say, a 50 basis point rate cut that Powell feels compelled to underdeliver on, and then that puts at risk the equity rally as well as indirectly financial conditions. And it's reasonably safe to say that the Fed would like to see equity valuations a bit lower to take some of the edge off of the wealth effect that has arguably been driving aspects of core inflation higher, but they certainly don't want to see a correction comparable to what was experienced in April of this year that was associated with sharply tighter financial conditions. After all, the Fed has communicated that they're on a glide path back to neutral, and whether neutral ends up being 325 or 350 or 3%, consistent with the longer run dot, is going to come down to the performance of the real economy and the perception that the economic cross-currents are consistent with moderating inflation on a forward basis and justify the committee's focus on the employment aspect of the mandate. Now recall that we did get the September CPI print, so we have a general sense of the overall trajectory of inflation going into the government shutdown. However, with the exception of that particular report, the market has been flying blind from an official data perspective since the 1st of October. We remain in the camp, assuming that we are going to have a record-long shutdown, which, to be fair, at this point is a relatively easy call, because that just means we need to get to Wednesday or beyond before we pass the previous record of 35 days. Now, next week contains a lot of potentially pivotal events, but the one that I think has been largely discounted by the market at this stage is the Supreme Court decision about the president's tariffs and whether or not they legally stand under the Economic Emergency Act, or if the administration needs to craft a different methodology for implementing these tariffs. Now, to some extent, the market seems relatively sanguine about the issue because the assumption is that if this particular path doesn't hold, then the administration will at least try to implement another workaround. And the other aspect of it is, let's face it, in April, there was a lot of skepticism about what tariffs would do to the real economy, what it would do on the inflation side, and whether or not it would generate any revenue of relevance. And what we have seen thus far, at least, is that the trade war has not collapsed the U.S. or global economy. We haven't seen 100% pass-through of tariffs leading to a spike in realized inflation. And, of course, as the Treasury Department has revealed, the revenue side of the tariff equation has been a marginal improvement to the overall deficit picture.
And so, at the risk of bringing up past economic cliches, there's the case to be made that maybe the specter of a soft landing is starting to appear as we look more closely at the economic outlook for 2026. After all, in defending his assertion that a December cut was not a foregone conclusion, Powell cited upside risks to the inflation outlook in no small part as a function of tariffs, as you touched on, Ian. and the fact that while the data picture is murky, the information that the Fed does have hardly paints a picture that shows a domestic consumer that's on the precipice of pulling back enough to really trigger a more significant downturn or technical recession. So then why did the Fed bother cutting at all in October, and why even leave open the possibility to another rate cut in 6 weeks if things are generally looking okay at the moment? Our take is that had Powell not erred more cautiously, then what we would have seen is a classic example of the market taking what the Fed said and running with it. What we mean by that is that we would have seen a December meeting that was priced between 22 and 25 basis points, probably quickly reach 25 basis points, and then even beyond as a larger probability of a 50 basis point cut in December was incorporated into market pricing. That would then put the Fed in the tricky position of delivering a tightening impulse by only cutting 25 basis points instead of the 50 bips the market was looking for, at a time when they are still worried enough, although clearly not extremely concerned, about the state of the labor market. And so, in addition to all the money market dynamics that were in focus over this past week, what Powell was successful in doing is bringing market pricing back toward more of a data-dependent stance, not implicitly guaranteeing another rate cut is in the offing, and he was able to do so without triggering any material weakness in risk assets or tightening in financial conditions. And so from that perspective, with the S&P 500 slightly off all-time highs and 10-year yields modestly above 4%, Powell is probably taking his October performance as a win.
And I think correctly so. The one thing that I will add is that the FOMC and Powell did a very good job of separating the balance sheet and funding stress concerns from the overall monetary policy bias. The Fed is still in the process of normalizing rates back to neutral. They don't seem especially hurried in that process. However, they did end QT, and they are going to allow MBS maturities to roll off into the bill market. Now, as you pointed out, Ben, $15 to $20 billion of maturities coming out of the mortgage market being rolled into bills in the secondary market isn't what we would typically define as a market moving flow per se. But what it does do is it does introduce the Fed's balance sheet as a tool for the very front end of the market. This is important as we think about Besant's objective of funding the bulk of the federal deficit, at least for the time being, in the very front end and the bill market. Now, we're not going to make the case that $15 billion worth of MBS maturities is the equivalent of the Fed attempting to monetize the deficit. However, in the event of an announcement of temporary open market operations focused on the very front end of the market, perhaps even an increase in the allocation towards the bill sector on the rollover and reinvestment front, there's a strong case to be made that the Fed has at least laid the groundwork in the event that Treasury's borrowing profile begins to add to what has already been demonstrated to be signs of stress in the funding space.
And in the discussion this week of whether or not interest on reserves or the standing repo facility rates were going to be tweaked relative to the target band, we fielded a lot of questions around the uncertainty of what's the point of temporary open market operations in the repo market if we already have a standing repo facility? Hasn't the Fed already addressed this issue? And our best explanation, in addition to the fact that TOMOs could be done over varying terms to cover things like month-end and quarter-end, is that the fact of the matter is there remains a certain stigma associated with utilizing the standing repo facility. After all, the program was introduced during a period of market stress, and the fact that this money market tool's original purpose was of an emergency variety is going to mean that there is an inherent reluctance by market participants to utilize it, even if it's needed. That same stigma doesn't necessarily apply to TOMOs, given that that's not an emergency measure, it's just a temporary patch to contain any money market volatility over sensitive calendar dates. It's a nuanced argument to be sure, but probably one of the best explanations that we've heard over this past week concerning what the Fed might do as it relates to containing money market volatility. Also, let's not forget that in the event we start to see SOFR spikes that the Fed is uncomfortable with, they don't need to wait for an FOMC meeting to announce additional support. That can happen, frankly, whenever.
And that's a good point, although the counterpoint is also kind of compelling, and that is if the Fed announces a temporary open market operation outside of the typical schedule, it begs the question, What is the Fed worried about at this particular moment that the market might not have otherwise been focused on? And that was always going to be the risk in the event that the Fed chooses to make such an announcement off cycle. In the past, the announcements have tended to not necessarily occur at an FOMC meeting, but they've been in direct response to moments of acute stress in the funding market. So indirectly, that makes the argument that if the Fed does need to follow through with such a program, there's probably something serious going on in the funding space. The other nuance, just to add to your nuance, Ben, is that participating in an open market operation flows through the dealership of a bank. So if a GSIB happened to be worried about the potential optics of the bank participating in the standing repo facility as opposed to the dealership, which would be more easily dismissed as liquidity or just baseline operational, as you point out, Ben, I think that the focus on temporary open market operations does seem warranted from an optic supply. And frankly, at the end of the day, Powell doesn't want to risk TOMO FOMO.
Well, it's taken a couple years. We had 2019's repo scare, then a QE program, then a QT program, TOMO FOMO, and I think it's safe to say we've finally put the fun back in funding.
This is fun. In the week ahead, the Treasury market will once again have a variety of tradable events from which to derive some type of direction. Although at the end of the day, we are very much on board with the consolidation that appears to be the path of least resistance in U.S. rates, particularly as we watch the 10-year sector continue to fluctuate around 4%. This seems like a reasonable departure point for the month of November. On the data front, we do have Monday's release of ISM manufacturing for the month of October. The consensus is looking for a sub-50 print at 49.1, although let's face it, the manufacturing sector has been in contraction for quite some time. Wednesday's release of ISM services is seen above 50 at 50.7, once again illustrating the divergence between the manufacturing and the service sector. Let us not forget on Monday afternoon, we have the Treasury's financing estimates for the quarter ahead, followed by the official refunding statement on Wednesday morning. Within the details of the refunding statement, the market will be focused on whether or not the several quarters language is maintained for keeping auction sizes stable. Our base case scenario holds that that will be the case. Bessent has made it very clear that he intends to utilize the bill market to fund the deficit for the foreseeable future, and any divergence from that messaging would certainly be a surprise for the market. With this backdrop, we're looking for stable auction sizes, $58 billion in 3 years, $42 billion in 10 years, and the long bond coming in at $25 billion. In addition, on the data front, we do have the ADP print for the month of October. Now, recently, ADP came out with some clarification about their weekly series and noted that as of the week of October 11th, ADP for the prior 4 weeks was running at an average of about 14.5 thousand jobs added. Such a figure would be consistent with the Fed's messaging that the labor market appears to have stabilized in this context, meaning not contracting, but certainly not reaccelerating into the end of the year. And that's one of the biggest wild cards at the moment. Whether or not the labor market bottomed over the summer and is going to improve into year-end, or if labor market conditions are going to remain in a sideways grinding mode, which frankly is our base case scenario. Such a backdrop of softer employment growth would also build the case for a rate cut in December as well. The week ahead also contains the Supreme Court's decision on whether or not Trump's tariffs will stand. The market's focus on this has been de-emphasized in recent weeks, and we anticipate that, in the week ahead at least, this topic will once again be top of mind for investors, if for no other reason than it could potentially add yet another layer of uncertainty for a market and for a real economy that continues to grapple with the fact that Washington and the administration continues changing the rules at such a pace that it's difficult to make long-term investment or long-term hiring plans until there is at least a fresh round of certainty. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And given that the theme from Powell's press conference was that the next cut isn't a foregone conclusion, we're left to ponder, well, what really is? Taxes? Tariffs? An especially quickly read disclaimer? Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.